All right, so in this video, I'm going to talk a little bit about kind of an overview of the business cycle and generally how things tend to play out, give or take, and some overall sort of general introductory kind of notes about it. So let's just kind of dive right in. Sometimes if you're trying to figure out sort of what's going on in the business cycle and where we are in an economic cycle, things like that, capacity utilization might be helpful to get an idea of basically what proportion of capacity is being utilized in terms of production and things like that. The higher that capacity utilization is getting, maybe we're more towards a top at some level. If we're, near historic kind of highs and things like that. Historically, bear markets, now this bear market is looking more at what the stock market is doing, and this is basically when the stock market is declining. Those bear market periods for the stock market are historically shorter. Bull markets, when the stock market is increasing, those are historically longer, and they do often end in some sort of a panic or some big sell-offs and things like that. Now, what's going on with the stock market and the business cycle in terms of the economy, they are linked, but they're not identical. Okay. So I'll talk about that a little bit more as we go. There's kind of a famous quote from Alan Greenspan. Alan Greenspan was Federal Reserve Chairman from the late 1980s until I believe the early 2000s. And in 1996, he had a statement in which he mentioned irrational exuberance in the financial markets. And that became kind of famous that he's saying, there's irrational exuberance. And looking back on it now, you kind of recognize, well, this was the tech bubble, right? That was going on from the late 90s, early 2000s, or kind of right around 2000, I think mid 2000, I think somewhere in there. Things may have kind of peaked. But basically, the tech bubble kind of didn't burst until like I think it was roughly 4-ish years later, give or take a little bit. So if you think about that, he was noting that, man, asset prices just didn't seem to make a lot of sense. There seems to be irrational exuberance, and it was years before the tech bubble actually burst. So from that standpoint, you could be kind of right about what's going on in terms of the economy and the stock market and things like that. But it could take a while for the market and the economy to kind of correct and to adjust. So there's a quote from Keynes, the economist. I don't quote him very often, but there is a quote from him, which is the markets can remain irrational for longer than you can remain solvent. And so, you could have a situation where valuations just stay super, super elevated. You look at it and you think that, some of this doesn't make sense. And that went on with some of the tech bubble. People were buying stock in companies that didn't really have any established track record of earnings or things like that. There's a lot of people piling money into just about anything that had .com in the name. And people were kind of right about the broader idea that the internet was going to change like everything, right? That was sort of the story that the internet was going to change how we communicate and how we engage in enjoying media and movies and videos and things like that, and how we engage in commerce. And so people were, that was kind of the story. It was going to change all these things. And the reality is it did. It changed so much of it. People were kind of right. But they were really kind of wrong on what they should have invested in and how much they should have paid for it to have benefited. So I mentioned that to basically know you could be very right about a trend in the economy and things like that, and even the ultimate impacts of a technology or something of that nature, and very wrong about when you should invest in it, at what price, how exactly when it's going to play out, and so forth. So something to just sort of keep in mind there. Generally speaking, you're looking at sort of the economy and also kind of the stock market as well, but generally, investor confidence tends to be higher near the top. So if investors are super confident, everybody seems really happy and optimistic, that's a little bit of a caution sign. It doesn't mean sell everything immediately, but it does mean, hey, that's a little concerning that everybody's extremely optimistic right now, because often it is high near the top. But conversely, it tends to be really low near the bottom. So investors tend to be super panicky, and they tend to be super pessimistic down near the bottom. And it's generally not that bad either. So from that standpoint, that's something to kind of bear in mind. If everybody's sounding super panicky, that doesn't automatically mean sell everything. In fact, by the time they're all panicky, you probably missed the point to sell anyway, right? And there's something to be said for just having a nice stable portfolio with nice reasonable allocations, and then just leaving it alone no matter what happens. Okay. That can work really well if you stick to a nice diversified portfolio and you stick that plan no matter what. That can actually work extremely well because you don't basically make bad decisions at the wrong times. Um, so as sort of a loose note here, on the sort of on the street, the common person, they tend to look at sort of like 2 quarters of negative GDP growth. In other words, the economy shrinks for 2 quarters as being sort of a recession, right? So you'll see that kind of tossed around as a definition of recession in various articles, news articles, and things like that. Formally, however, in terms of the National Bureau of Economic Research and things like that, basically it's a lot more complicated. And so it's going to be based upon numerous factors. That's not going to be the definition. They're going to look at all kinds of data and try to figure out if there's a recession. Importantly, for that, trying to figure out if there's a recession with that formal assessment and everything else, they're also not going to be in any kind of a hurry to figure out if there's a recession. They're going to be more focused on getting it right for the sake of sort of posterity, of recording the historically this was a recession and this was not, right? So from that standpoint, don't expect like the NBER to be out there in a real hurry to say this is a recession. That's not typically what they do. They're going to be looking at the data over time, trying to pinpoint starts and ends of recessions, and using the most data possible. And they're going to look at all kinds of factors, not just GDP growth. Now, importantly, if I'm looking at the average investor, I would argue that the average investor tends to make kind of the wrong decision if he's making a bunch of decisions, because the average investor tends to get a little bit too greedy or optimistic near the top, and everything's been great, things have been going up, I should pile more money in, I'm going to make more money, and tends to make poor choices and buy at the top. Buying at the top is not good. Conversely, when things are terrible, the economy is gone into a recession, the stock market has cratered. The typical investor tends to be feeling a lot of fear and tends to basically want to just sell everything and be done. And of course, selling at the bottom is a terrible time to sell. So from that standpoint, I would argue the average investor tends to be wrong, basically at the top and the bottom. And they actually have done some studies of individual investment accounts. And essentially, when they've looked at some individual investment accounts, the performance of individual investment accounts tends to be significantly worse than if you just bought like an entire index and just did nothing after that. They just held on. So a lot of investors are actively going in and basically making poor choices. And the idea is either they're investing in the wrong stocks or whatever else, and there's a lot to be gained from just investing in a nice diversified group like an index fund, or they are buying too much at the top, they're selling it all at the bottom, things like that. But in either case, basically, it tends to end somewhat badly. Now, let's kind of look a little bit at sort of how this sort of generally plays out. So I mentioned in a prior video when I had a diagram that looked kind of like this. There are a few little notes here. So this is the economic trough, or sort of think the recession period. Or the recession period would be kind of all this downward period here. So this would be sort of the end of the recession. And then I'd have this part here, which would be economic growth, and that would be sort of the economic expansion, and this would be the economic peak, so the end of the expansion. So if we're looking at those, generally speaking, the recession period or contraction, which is what we have kind of over this downward slope here, that would tend to generally be much shorter. So, think 6 months, 9 months, year, whatever, tends to be shorter. So the contraction tends to be shorter. The expansion tends to be longer. Think several years. Could be 2, 3, 4, even, more like 7, 8, 9 years. You could have some longer expansions. So expansions tend to be longer than the contractions. So this diagram is not fully drawn to scale. It was just easier to draw it this way. But also, it's worth noting that in general, historically in the U.S., the economy has grown overall. So although I have this kind of up and down, really I should kind of tilt it so that it's going up and down while gradually growing. So the overall trend is basically involving growth. Okay. So from that perspective, let's kind of walk through sort of how some of this plays out a little bit. And it's important to note that although the cycles tend to play out in a similar manner, not every situation plays out exactly the same or is going to fit perfectly on this, okay? But this gives you sort of a general idea. Often things kind of behave somewhat like this. And you'll see some features of this that tend to look kind of like these different features. So don't get hung up on some things when a cycle arises and things are a little different. Every cycle is a little bit different, but they're also in many cases similar, right? So from that standpoint, let's kind of from perspective, let's kind of start here. So let's kind of start with kind of what goes on with like a recession. So I hit a peak, I slide into a recession, right? So once I start sliding into a recession, generally unemployment starts to rise after the peak. Unemployment is sort of a lagging indicator. So once things start to deteriorate in the economy, eventually companies start laying off people. They don't hire as many, and that's why unemployment starts to go up typically. Somewhere in here, often gold kind of tends to peak out. Gold's kind of interesting because sometimes people pile all their money into gold, basically because they think that they are, it's going to preserve their wealth and everything else, right? So they tend to run to it to safeguard their money. Now, a little side note, there is no asset that's guaranteed to safeguard your money. And it's totally possible to lose your money in gold, just like it's possible to lose your money in stocks, bonds, or any other investment. Okay. It depends an awful lot on what you pay for it. So, as a historical example, if you had bought gold at the peak in the late 1980s, your gold investment, not even accounting for inflation, would have been underwater. In other words, negative returns um, until I think it was the early 2000s, somewhere in there. So roughly 20 years, give or take a couple of years. Okay. So roughly a 20-year period, in which case you would have actually been negative on your returns net from if you bought at the peak. Okay. So from that standpoint, can you lose money in gold? Absolutely. Does that mean you're always going to? No. Does it mean you're always going to make money? Absolutely not. It just, who knows, right? So the reason I mention that is sometimes people think, well, I'm just going to, I can't lose money in gold. Oh, but you can, right? You can lose money in anything if you pay too much for it. Okay. So again, if you happen to be buying at the peak, you can totally lose money at that. Even if you happen to buy at just elevated levels, maybe not a peak, but it's elevated levels, you'll lose money, right? But generally, gold tends to be going up and peaking somewhere in here. And the reason for that is when the economy starts going to a downturn, people tend to be looking for something safe. Gold tends to be one of those things. So they tend to run for something that's safe. Also, typically what you have is a fair amount of inflation. So let's rewind a little bit. Inflation is too much money chasing too few goods. If I go back, when I had all this growth going on in the economy, all that growth and all that wonderful economic environment led to people trying to buy stuff, expand, etc. Money was chasing goods. And so as a result of money chasing goods, typically you had higher inflation up here near the peak. And so inflation starts to fall somewhere over here as you have basically less money chasing the goods. Now, once inflation starts to fall, somewhere in there, the Federal Reserve looks at the situation and they realize, oh, the economy looks like it's starting to contract. It looks like inflation is actually diminishing. Unemployment's starting to creep up. This isn't good. They start lowering rates. Okay. Now, keep in mind for the Federal Reserve is in an interesting situation in that they're trying to make decisions for what they should do for the economy based upon data that takes a while for them to get and is in some cases backward looking. So in other words, by the time I get the GDP data for a quarter, the quarter is already over. So from that perspective, the data that I have, if I'm the Federal Reserve, is historical data. The data has already happened. Now, they're going to look at some things that tend to be leading indicators, things that tend to churn before the economy. But no, there's no perfect leading indicator, I would argue. Maybe a mixture tends to do pretty well. We have a forecasting and projecting, and they've got models to try to project and everything else. But there's no perfect predictor, right? So from that standpoint, if you're the Federal Reserve, you're working with a lot of data that in many cases is backward looking. It's from a prior period, hopefully relatively recent, but it took a little while to gather it. And they're trying to make decisions based on that for what they need to do going forward. So the example I have used in the past with people with this is the Federal Reserve is kind of like trying to drive a car down the road, but with a sunscreen blocking the windshield. And they're driving down the road based on what they can see out of the rearview mirror. And so if you imagine trying to drive down the road blocking the windshield and only looking through the rearview mirror at what's behind you, well, I mean, you can kind of more or less stay on the road if there's nobody else there, right? If there are no other cars there, I mean, you can kind of more or less stay on the road if you went really slowly, because you can kind of sort of figure it out if you knew what the road kind of looked like. But if there was anybody else on the road or anything else, I mean, you're going to blow through stoplights, you're going to hit other cars. I mean, it's going to be a mess, right? So, I mean, it sort of works a little, but it's a terrible idea. Don't ever try it, right? But that's kind of the situation the Federal Reserve has at some level, that they have data from before. They're trying to figure out where does it look like things are going, and they're trying to map out the best path based upon some historical data. And this is why I would argue at some level the Federal Reserve is somewhat of a thankless job, because no matter what you do, somebody's going to wind up upset with you. You raise rates because you think inflation is too high. Everybody who's a borrower is unhappy. You lower rates because you think the economy is maybe a little bit weaker. Anybody who is trying to live off of a bond portfolio or something like that, or money stuck in a money market account, the interest they're earning, they're unhappy with you. There's always going to be somebody who's unhappy with you, right? So, but in any case, generally speaking, unemployment starts to rise, inflation starts to fall. Somewhere in here, the Federal Reserve, they're looking at all this data and they're gathering and they think, you know what? Not looking good. We need to lower the rates. So start lowering the rates. So as a result, money markets, the rates are going down. So money market rates start to go down. So that kind of has peaked out. Now, when rates go down, bond prices go up. So for interest rates go down, bond prices go up. So generally, when they start lowering the rates, that's going to start to signal a turn in the bond market, because as the rates start filtering out through the market and they're going down, the bond market's going to tend to go up. What I mean by the bond market, I mean bond prices are going to be going up. Okay, so interest rates are going to start drifting downward. They won't necessarily all change for all bonds all at the same time in the same way, but they're going to start to generally go down, and the bond prices are going to go up then as a result. Now, sometime thereafter, as the economy is getting, it's still sliding into a recession, we're having kind of not a great economic period. Somewhere, eventually in there, the stock market's going to hit a trough. So the stock market's been going down here with the recession, but eventually the stock market's going to hit a bottom. And that's typically going to happen probably before the economic trough or the bottom of the economy. And here's why. Stocks are based upon expectations. The value of any asset or investment is the present value of all expected future cash flows. So if I look at a stock, if things are lousy, well, that's partially why the stock market's been dropping, right? So that would be why we'd have a bad stock market and so forth. But eventually, people start to see glimmers of hope that maybe the economy is not dropping as fast, and maybe there's some signs the economy is starting to stabilize, and things might be starting to look a little bit better than they were. And so if expectations start to improve, then the values of the stock start to go up, because the value of any asset or investment is the present value of all expected future cash flows. So as those expectations improve, then the stock prices might turn. So it's not uncommon that the stock markets might start to improve when the economy still is doing kind of poorly. So stock market typically would start to improve before the economy has fully recovered as well. Then eventually hit the economic trough. So the GDP is bottomed out and starts to improve. Now, just because the recession has stopped and the economy goes back to growing doesn't mean that everybody feels that everything's wonderful. So you could have a situation where the economy is growing, but it's not growing very fast. And if it's not growing very fast, a lot of people are still unemployed, then they may not feel like the economy's gotten all that much better. So technically, the economy may actually be expanding, but a lot of people still may feel like it's pretty lousy, right? Sometime after the economy has turned, generally that's when unemployment is going to start to go down. So in other words, more people are getting jobs. It takes a while for businesses to start hiring people. They need to start making more money, see more prospects of profitability before they start expanding, rehiring, et cetera. So it can lag before unemployment starts to go down. Also, as an interesting little note, unemployment is looking at the proportion of people who are seeking employment who can't get jobs. Okay. So if you get discouraged from looking and you just don't even look for a job anymore, you don't count as unemployed. So if the economy starts to recover and people who had given up looking for work actually start thinking, maybe there's a chance again, and they start looking again, they will count in the unemployment tally, which could make unemployment a little sluggish to go down, because I could have more people getting jobs, which is great, but now I have other people who are re-entering the calculation because they start looking for jobs again. So unemployment can be kind of sluggish. Eventually, sometime after the recovery, the economy starts improving and doing better. More money is chasing goods. Inflation starts to rise again. And when inflation starts to rise again, then eventually gold tends to hit a trough there because the economy is doing really well and people aren't as worried about things, aren't panicking, so it tends to hit a trough. Once inflation starts to rise, the Federal Reserve starts raising the rates again to deal with inflation, which means money markets start to look progressively better. So they hit the trough for that. Pardon me. And once those interest rates start to go up, the bond prices start to get pushed down. So the bond market's going to hit a peak. And generally, stocks tend to continue to do well for a period of time. And the reason for that is even though the interest rates are going up, which is harder for companies to make money with the higher borrowing costs, the economic growth tends to support them. And so if they have enough economic growth and the profits are growing robustly enough, the expectations are still there, the stock market continue to grow and do well even in that environment. Eventually, sometime later, the higher interest rates start to weigh on that, the economic growth is slowing, the prospects get worse, and the stock market kind of starts to peak. And then sometime thereafter, that the higher interest rates and slowing economy eventually push the economy into an economic peak, and then I start to slide back into that recession again. And then the cycle, tends to repeat. So hopefully this sort of overview of kind of roughly how the business cycle tends to work has been helpful. Thank you so much for watching and have a great day.